Hello. So first this week we are going to review problem 3-13A, 14A, and 15A. I'd like to go over the accounting equation, assets, liabilities plus owner's equity. To increase an asset, we are going to debit, and to decrease an asset, we're going to credit. For a liability, it's the opposite. We decrease a liability by a debit, and we increase a liability by a credit. Owner's equity, again, we debit to decrease, and credit, we increase. Debits are always on the left-hand side, and credits are always on the right of the T account. So let's start. We're going to invest in the company $20,000. $20,000 is always cash. We're increasing cash, so we're going to debit cash and credit increase capital. Next, we're going to buy a van. So we're going to use cash, so that's going to decrease our cash. So we need a debit. You will see that we are going to debit our van, which is an asset account, so we're increasing it, and credit cash and decrease cash. Next, we're going to purchase equipment, but we're going to purchase equipment on account. So, office equipment, $5,000, and we're not going to pay for it yet. So we're going to put it as an accounts payable. We're going to increase the liability by $5,000. Next, accounts receivable, received cash for services rendered. We got paid. Receiving is always going to increase our cash. And we received a service fee. Revenues are also increased by a credit. Paid cash on account from transaction C. So we're going to pay off a little bit. So we're going to credit our cash count and debit our accounts payable, because we're going to decrease the amount of money that we owe. Paid rent for the month, that's decreasing our cash, and paid rent, which is an expense. So we're going to debit our expense account and credit our cash account. We're also going to pay our telephone bill. It must be the first of the month and we're paying all our bills. So we're going to debit our telephone expense and we're going to credit cash. Earned revenue on account for $4,000. It means that they have not yet paid us. So we're going to debit our receivable, accounts receivable, and credit our services because they've promised to pay us. Purchase office supplies for cash, $121. So we're going to debit our office supplies, and decrease our cash credit. Paid wages to student for $600. We're going to debit wage expense and credit cash. Purchase 1 year prepaid insurance. So prepaid insurance, $1,200, debit, and we're going to credit cash for $1,200. Received cash from services performed in transaction H. Means they finally paid us. So here is $3,000, and we're going to decrease our receivable by $3,000. Paid cash for gas and oil expense for the van. So gas and oil expense, we're going to debit, and we are going to credit our cash account. Purchase additional equipment for $3,000, paying $1,000 in cash and spreading the remaining payments over the next 10 months. So we're going to increase our office equipment by $3,000, and we've paid $1,000 in cash and accounts payable for the rest of the money. Earn service fees for the remainder of the month of the $3,200, $1,800 in cash, and $1,400 in receivables. So we've received cash of $1,800, $1,400 is receivable, and the total is a service fee and a credit. Withdraw cash at the end of the month because we want to get paid too. So we go to our drawing fee and debit $2,800, and we like cash, so we're going to reduce our cash credit by $2,800. Next, what's required is to do a trial balance. So we must total up our columns. First, we're going to total the debits and credits, and then determine whether it's a debit balance or a credit balance. Since our debits is a larger number than our credits, we have a debit balance for cash of $14,820. The same is true and should be true of all our assets. Our liabilities usually have a credit balance. We have a debit balance for our drawing. We have debit balances for our expenses, and we have a credit balance for our fees. We're going to put this all on a trial balance because remember, the most important thing accountants can do is have everything in balance. So we list each and every account: cash, accounts receivable. We first list all our assets, then our liability, then our owner's equity. And we total all our debits and all our credits. And yes, we are in proof. So now for 14A, they ask you, what is our total revenue for the month? $13,200. B asks us our total expenses. So if you look, our service fees is all our revenues, and all our expenses are expenses. And that's where I'm getting the number from. We take our revenue less our expenses, and the net total is our income for the month. For number 2, we want to see what his original investment, how much of that do we have left, and are we in a better frame now than last month? So we take the original investment of $20,000, the net income of $11,340, less what we've paid ourselves, and then we have our increases in capital. Now we have a new owner's equity. We always make sure that our assets equal our liabilities and owner's equity. Last and most important is we need to do the income statement. We list just our service fees and just our expenses. And that is our net income. Revenues less expenses gives you your net income or your net loss. We also have to check our statement of owner's equity. And so we take the investment that we put in May, we add in our income, we reduce it, less withdrawals, we have our increase in capital, and now Harold Long capital is $28,540. We always check our balance sheets. We take all our assets, our liabilities, and owner's equity, and they must always agree. And that is it. Use this to complete problems 13B, 14B, and 15B.